Okay, we're back. We're now here to talk about limited liability companies. Chapter 40 of the Maller book, the references to limited partnerships and LLPs, limited liability, limited partnerships, we're not going to be really as focused on. We've already covered whatever we're going to need to cover around limited partnerships and the distinction between a general partnership and a limited partnership. But the focus here is just on the LLCs in Chapter 40. So what is an LLC? I think we went over in some of the previous lectures the fundamental difference between the different, as an overview, among the different forms of business organization: sole proprietorships, limited or partnerships, corporations, and now LLCs. Whereas a corporation, unless you're an S corporation, typical C corporation, you have double taxation. You're taxed at the entity level as well as the individual shareholder level. At the partnership structure, it's what's known as a pass-through entity. A pass-through entity, meaning you're only taxed as an individual partner. So pass-through. So if you're a partnership, you're taxed, sorry for flipping this around, you'll be taxed at the partnership level, or excuse me, you'll be not taxed at the partnership level, but instead at the individual partner levels. So not taxed here, just these individuals here are taxed. If you're a corporation, this is if you're a partnership, if you're a corporation, a C corporation, in fact you are taxed here, as well as at the distribution level if you have dividends distributed to the individual shareholders. So that's a partnership and a corporation. LLCs have the attributes of a partnership. So here's the LLC. You are not taxed at this LLC level, you're just taxed at the individual level. And we call these individuals, what we call them, members. So LLCs are also pass-through entities. And that's a very valuable thing, right? Because you're not subject to double taxation. The other benefit, or or attribute, I should say, also of the LLC is that it's limited liability. So that like a corporation, and unlike a partnership, if you're a general partner, where there's unlimited liability, the liability of a member of an LLC is limited to the amount of their particular investment. So members are taxed at, or excuse me, not taxed, their liability is limited to the amount of their contribution to, or the value of their membership in the LLC, just as it would be if you're a shareholder in a corporation. So what's interesting about LLCs is we call them kind of a hybrid in the sense that they contain the attributes, the tax benefit attributes of a partnership, of a traditional partnership, combined with the limited liability attributes of being a shareholder in a corporation. So they really combine the best of both worlds. They're fairly new in historic terms. Again, state law for LLCs, and they're primarily set up that way, as all these entities are. It could be governed by state law, but they're fairly new, as I said. The first one came into effect in Wyoming in 1977, so it was a long time ago, but in legal terms and historic terms, it's actually pretty recent. So how do you set up an LLC? Well, like a corporation, and we'll learn about this, sole proprietorship, you can just get up and start your enterprise. Partnerships, we've learned, you preferred to have a partnership agreement, but you need not set up a partnership agreement. Now, to have it written, it can be actually based on a party's conduct, construed under law, etc. But you actually need to take certain steps. You need to do certain things for the LLC to be established. To create an LLC, you have to actually file a certificate of organization, with the Secretary of State. And you have to take this action. The state actually has to accept it and approve it for the LLC to come into existence. This is what distinguishes it from a sole proprietorship, where there is no entity, no actions taken. Same thing with a partnership, where you don't need to necessarily file anything either. But in the case of an LLC, you need to take these affirmative steps, and you do it ordinarily with the Secretary of State in the state in which the LLC is established. So you file the certificate of organization, and it sets out the name of the LLC, the address of where it's registered, who the registered agent is, because an LLC is just ABC LLC, it's just a name. There has to be some human being or some organization that's there, some address, some physical thing that can receive communications. So if there's a lawsuit that's ever filed against you, for example, tax notices that need to be sent, there's a registered address where that will go to. As I said, the people that own the LLC are called members, and the member of an LLC does not have to necessarily just be an individual. You could be a partnership, right? A general partnership can be a member of an LLC. A corporation can be a member of an LLC. So it can get very, very detailed and complex in terms of ownership structure. Point to make here is members don't necessarily have to be an individual. They can be these other entities. And there's hopefully a document that's created that governs and sets up the governance of the LLC, and that's called an operating agreement. That's referenced on page 1009, and that's an agreement with all the members. It's essentially a kind of a partnership agreement, right? It enumerates the rights and responsibilities of each of the members. What happens if one of the members wants to sell their interest? What happens if one of the members wants to dissociate? What happens if new members are entered into? And again, if we don't have an operating agreement, just as if you don't have a partnership agreement, you go to the default rules. What do the default rules specify? Well, they're specified in the RULCA, which is RUPA, Revised Uniform Partnership Act. RULCA is the Revised Uniform LLC Act. Figure 1, quite helpful. Let's quickly cover that. And then I want to also go to figure 2 on page 1017. Or excuse me, just figure 1 on page 1010. An LLC may be created only in accordance with a statute. So as I said, you've got to go through these specific steps for the LLC to be established. An LLC is only owned by members, and members usually have liability that's limited to their capital contribution to the business, or whatever the value of the LLC has grown to, their ownership portion of that business. It says, qualified by the word usually. We'll get into this when we get into corporations. We talk about piercing the veil. There will be certain circumstances under which we will dig into the pockets of the members, in the case of corporations and the shareholders. But those are unusual circumstances. It does come up, but it's not sort of the norm. There has to be some really wrongful bad conduct. LLC members share equally in the profits of the business unless the members agree otherwise. Again, kind of like a partnership, right? Profits are split equally unless the members set forth something different in the actual LLC agreement, which we call and refer to as an operating agreement. There's a couple different ways to set up the LLC. You can have a member-managed or manager-managed LLC. Okay, so you've got the guys that are owners. Those are called the members. The people that actually run it on a day-to-day basis are called managers. To be a manager, you don't have to be a member, meaning you can have professional people that are essentially hired, retained to be the managers. But the people that run it, just to get the basic lingo down, are called the managers. In a corporation, they'd be generally referred to as officers, but we're not covering corporations now, we're covering LLCs. They are called managers. You do not need to be a member to be a manager. However, of course, you can be as well, which is why we come up with these designations of member managed or manager managed. And that can become significant as we get into this material a bit more. If it's member managed, each of the members has an equal right to manage the business. Now, a member who manages the LLC has a fiduciary duty to the LLC and its members. Okay, you've got a fiduciary obligation, that highest possible duty that we talked about in the context of partnerships exists here for members who are managers. Very, very important point. Now, members, if they're just members, in the context of being a member, that doesn't mean you necessarily have a fiduciary duty to the other members. You, in all likelihood, do not. And the Cattrus case, which we'll get to in a second, kind of covers that concept in part. So, like partners have fiduciary duties to each other, the members who are managers have such fiduciary duties to each other and to the LLC and to the LLC members. A membership's ownership interest in an LLC is not freely transferable. You cannot freely transfer an LLC interest. You just can't, kind of like a partnership interest, not freely transferable. However, a transfer of a member's distributional interest is possible in the context of receiving those distributions. So again, kind of like in a partnership, you can't freely transfer your actual member interest, but what you can do, this is in a partnership, you can't freely transfer your partnership interest. But what you can do is the proceeds that are associated with those profits or those distributions, you can decide to allocate or designate to who you wish without any limitation. A death or withdrawal of a member does not usually dissolve the LLC. An LLC kind of has a life of its own and it can continue on unless otherwise specified. And members of the LLC may choose to have it taxed as a partnership or a corporation. Again, LLCs, for our purposes, consider them pass-through entities. Most people will select the LLC precisely for that reason, so they can be taxed not twice, but only once at that member level. So again, to recap, major benefit of an LLC, taxed only once, no double taxation, not at the entity level, just at the distribution level, at the member level, kind of like a partnership. Unlike a partnership, however, it is limited liability limited of the members to the value of their contribution or their, whatever the value of their membership interest is. That's the most they can possibly lose. In that regard, really identical setup to a corporation in terms of liability. So some of you may be thinking to yourselves, at least I hope you are, is, well, gee, that sounds like a great, perfect world. You've kind of married the best of both worlds. You've taken the pass-through attributes of a partnership, you've married that with the limited liability attributes of a corporation. Gosh, that seems perfect. Why wouldn't everyone simply become an LLC? Kind of like an S corporation, right? Again, we'll get into corporations in the next lecture, but we did talk about S corporations, though, and S corporations do have those benefits of limited liability coupled with the pass-through component, right? You're only taxed at the member level or at the shareholder level. The challenge with that is you're limited to 100 or less in terms of number of shareholders, so it really doesn't apply to corporations that have a lot of shareholders, certainly not to public companies or any of the public companies we'd be familiar with. So it really comes down to the basic question again of, gosh, why wouldn't anyone want to be an LLC? It sounds like the perfect environment. Well, here's some reasons why everyone would not want to be an LLC, okay? Reason number one, it's still fairly new. Now, I know that may sound silly in the context of 1977, that was a while ago for most of us, before we were probably born, or most of you were born. But the point is simply that in legal terms, in legal historic terms, it's not a very long time. It's actually a very short time when stacked up against thousands of years, going way back for existence of partnerships. Corporations have been around for hundreds and hundreds of years. the law is much more evolved and developed in those areas. LLCs, much more narrow, smaller area of law, less law that exists, less certainty perhaps. So as a result of that, sometimes businesses will take that into account because businesses want consistency, want certainty, and that's an issue. I think less of an issue as time obviously goes by. LLCs are very widespread use of them, so maybe less of an issue, but still a consideration. I think the bigger issue, though, the bigger consideration is simply the fact that, kind of like a partnership, LLCs kind of get a little cumbersome, right? Those interests, those rights are not freely transferable. Your interest in your member units, you can't just transfer to the next person. It has to be described or governed by whatever the operating agreement says. If the operating agreement does allow for it, that's great, but still it's going to not just be a completely open-ended deal, because I guarantee that whoever sets up the LLC is not going to want to make it some free-for-all. They're going to want to place restrictions on it, on what happens, what doesn't happen. So the very fact of adding new people, and that fundamentally is what we come down to here, because when you're talking about scaling up, about creating a large enterprise, about bringing in a lot of different investors, partnerships, LLCs, obviously S corporations are limited with, just by virtue of, subchapter S of the revenue code, which limits the number of shareholders. You really are coming down to C corporations as the vehicle under which enterprises that have a lot of investors or may want a lot of investors in the future, that's the vehicle that they're going to choose. It becomes very cumbersome to start adding people. And LLCs, the good LLCs, will all have an operating agreement. The book does point out it's not a requirement, but it's really pretty foolish not to have an operating agreement if you set up as an LLC. So that operating agreement is going to specify processes for adding, taking people out. It gets very, very cumbersome to keep adding, to keep amending the operating agreement. So for that reason, LLCs are, I won't say disfavored, quite the contrary, LLCs are utilized probably more frequently than any other business form for certain types of businesses. So if you're in a business with a limited number of investors, and it's going to remain that way, you're not going to be seeking a lot of new people or any new people to come on board later on, and you've got certain very clearly defined purposes, or maybe it's a small business. LLC is a terrific vehicle to use, as is, I think, an S corporation. But LLCs are very, very widely used for that purpose. But if you're thinking in terms of, creating the next Facebook, or launching some company that's going to have an initial public offering and get all these different investors, or getting even well in advance of that, getting a lot of seed money and then different rounds of venture capital and investment, you're not going to go for the LLC. Everyone's going to insist upon a C corporation setup, precisely for the fact that it enables and facilitates the free transference of shares, creates opportunities for different classes of shares, and we'll get into those different classifications that can be utilized. By the way, just as a sidebar, you can have different LLC member unit categories. You have a lot of flexibility in what you can do there. Flexibilities that don't exist, for example, in the context of S corporations. Foreign ownership is prohibited, and other things in the context of S corps. A lot of those limitations don't apply with LLC. So when weighing the choice, it's often not between a C corp and an LLC. It's between an S corp and an LLC, and trying to weigh the respective pros and cons. And oftentimes the LLC is a very, very good alternative. Okay, in terms of the duties, as we talked about, member managed LLC, and each manager in a manager managed LLC is a fiduciary of the LLC and its members. So bottom line is, if you're a manager, whether it's member managed or manager managed, there is a fiduciary obligation to those members. And the same duties of care that we covered in the partnership section, I'm not going to go over again, would apply here. well, I guess I am going to go over it again slightly. Duties of confidentiality, duties not to compete, duties of not to take interests that are adverse, duties to account, duties of confidentiality. All of those duties do apply to the manager of the LLC, to the LLC, and to its members. They have a duty of care to act within a person like and that person would, act exercising reasonable care. That exists, across the board. That is the way that it works. However, if you're a member of an LLC, you owe no fiduciary duties to the LLC. It's kind of like being a shareholder in a corporation. We'll get to this again in corporations. I think there's a reference in the book later on in the corporations section, which you can disregard, about fiduciary duties that shareholders have. Let's just assume for our purposes, shareholders have no fiduciary duties. In other words, you can own shares in Burger King and McDonald's, okay, as a shareholder. There's nothing that prohibits you from doing that. By contrast, can you be, on the board of directors of both? No, that would be a problem because they're in direct competition. People would legitimately ask, how can you possibly fulfill your fiduciary obligations? There's a clear conflict of interest. You're taking positions that are adverse. You're in a position to maybe share, even if it's inadvertent, confidential information of one with the other. Just not going to go there. But as a shareholder, no preclusion. Similarly, like in corporations, no such limitations for LLCs. Okay, let's take a look at the Cattrus v. Carroll case. This is a fairly complicated case, and I urge you to spend some time with it. I'm not going to spend a great deal of time with it here, but kind of sketch it out. Get out a piece of paper. This is what you should do with really, frankly, all the cases, but particularly the ones that are a little more complicated factually. But here's basically what's going on, just to give you a big picture. What's going on is you've got a few initial founders of this software company. And the question is, it's an LLC. The question is, was one of the founders a manager or not, based on the facts? And secondly, if they weren't a manager, if they were just a member, what duties were owed? What fiduciary duties may have been owed? And as we've just learned, if you're a member, if you're just a member, you have no fiduciary duties. To get to that level of fiduciary obligation, you need to be an actual manager. Here, the facts did not support this person being a manager. The resolutions that purportedly did that were, defective. He had a title indicating that he may have been somebody, with that obligation, but in fact, he didn't. And what did this guy do? He was actually working with a competing enterprise with a competing product. If he were the manager of the LLC, that would be a slam dunk violation of a fiduciary duty. But because the facts did not support that outcome in this case, no liability. And I always ask the students, doesn't that still create some problems here? Doesn't that bother us in some way that you could be working for one company, and this guy was actually one of the founders of the company, one of the original shareholders of the company, and on the side doing something for a competitor? Just because you're not a manager, if it's set up as an LLC, you're somehow free to do whatever the heck you want? That doesn't sound right, does it? And you know what? If you feel that way, you're correct. It isn't right. But that's not what the case is about. The case is about trying to determine whether or not a member has a fiduciary duty, and they don't. That doesn't mean the corporation or the LLC couldn't have created some other mechanisms to protect their rights, which they didn't do, evidently, based on the limited facts here, but which they could have done. What could they have done? We'll get to this much later in the semester when we get to the employee section. But they could have done stuff like, because the guy was also an employee of the company in addition to being a member, make him sign certain agreements, right, that would protect the intellectual property rights, the confidentiality of the company. That would be a binding agreement. he would be supported by that. The company could have created some specific company policies which would have prohibited that sort of competitive behavior as well. But there's no prohibition otherwise, legally. So that's really the sum and substance of the Cattrus v. Carroll case. The undisputed facts show that the guy at issue here, Doherty was his name, was a member of the LLC, but since he didn't exercise any managerial authority, meaning he wasn't a manager pursuant to the LLC operating agreement, show that he owed no fiduciary duties, and therefore he was free to do whatever, well, more or less whatever he wanted to on the side without the same level of scrutiny that would otherwise ordinarily exist. As I said, we're not going to be concerned with Figure 2, principal characteristics of limited partnerships and LLPs. Likewise, don't worry about the rest of this chapter. And I think that pretty much ends where we're at. I think I've covered what we need to know for now. Any remaining issues with LLCs will be picked up in the next upcoming discussion. But from our purposes, we've covered a lot of it. I think we'll be moving on very shortly to corporations. So that concludes our discussion on LLCs, and look forward to speaking to you the next time. Thank you.